Welcome everyone today to our webinar with Fuquan Bale. He's going to be discussing notes with us, so we'll jump right into this. My name is Ryan Fisher with CamaPlan. Basically, what Fuquan's talking about, you're going to be able to use outside of an IRA or using your tax-deferred or tax-free accounts. You can invest in anything using a self-directed IRA that you want. There's a few things the IRS prohibits: collectibles and life insurance. Other than that, you're most likely able to invest in it. These are some of the more popular investments that we see our clients doing. I'm not going to focus on these. I'm just giving you guys a quick visual. Again, Fuquan is going to go through some note scenarios here for us today, and private companies and startups as well. You can use all these types of accounts. On the left-hand side are tax-deferred, on the right are tax-free accounts. It doesn't matter which type of account you're using. The same, note you buy in your traditional IRA, you can buy in your Roth IRA. You can use all these accounts. You can combine them together or partner them together to make an investment. If you have any questions on that, let me know. Basically, this gives you the ability to invest in what you guys know, understand, and can control versus using hope in the Wall Street world. This is my contact information. You're able to reach me anytime at the office or email me. You're welcome to set up a phone consultation right from our website. I would suggest everybody or anybody who hasn't been there, there's a lot of good information. There are recorded webinars just like this that you can look at that are free under the Cama Academy tab. If there's anything I can help you with or any questions that you have, just let me know. I'm going to go ahead and turn it over to Fuquan here today. Alrighty, Fuquan, welcome. Appreciate you being here with us today.
No problem. Thank you, Ryan. Can you see my screen?
I can.
Perfect. All right, we'll get started. I want to take this time to thank everybody for attending this session. I know for some of you it's probably your lunch hour. For some of you joined to get more information on the different strategies that you can use, in note investing. So basically, I just want to give a disclosure. This presentation is educational. Nothing should be construed as legal advice. If you need that advice from a legal or accounting, you should seek those professionals. It's not a public offering or fundraising event. And basically, I've been in the real estate business for about 18 years, and I've been in the note business since 2012. And it's been a long journey, learning different types of strategies that one can use once they take a non-performing note to performing, and or if they buy a note that is already, producing income. So for some of you who may be new to this, I'll just go over some high-level stuff, and then I'll jump right into, the strategies you can use. There's a lot of people who have retirement accounts and they're just focused on real estate investing. Some of you may be doing, first trust deed investing. So the strategy that I'm going to tell you about will apply there also. A performing note to me is something if you did a first trust deed loan to someone from your IRA account or outside of your IRA account, and you are receiving monthly cash flows, that is an asset that you can hypothecate. So for some of you who are not in the note business, basically a note is an IOU. It's a cash flowing instrument. It's also a series of payments. Of course, it's financial freedom and it's secured by a mortgage. So some of the things that secure your investment in this space is, of course, the promissory note, which has all the terms that the borrower or debtor must pay. The deed of trust or mortgage, depending on what state it's in, is the collateral. And the assignment of the mortgage basically gives you the ownership if you're buying in an institutional space or sell a carryback notes, or if you sell something that you put a first trustee lien on, that assignment will give the buyer the right of ownership. And of course, the allonges from the note. Also, to secure your investment, you want to be as an additional short on the insurance policy. So basically,
Fuquan,
yes.
I just wanted to let everyone in the audience know that they're welcome to put any questions that they have in the chat box, and when you take a break there, I'll, ask those questions to you.
Okay, absolutely. Yeah, just load your questions up. I'm going to run through these slides. I'll try to go as slow as possible. And at the end, if you want to ask questions, I guess you can unmute yourself. I'm not sure, and then we'll get those questions answered.
They can put them in the chat box as you're going through, and I'll take a look at them. Yep. Okay.
Awesome.
Great.
Awesome. So basically, the note, if you're new to this investment, just explain the terms, the interest rate, and a couple other key items to the note owner. The allonge is the document that transfers the note ownership over to you. And then you have the deed of trust, depending on which state you're in, which is the assignment of the collateral that's attached to the property. Or you have a mortgage, and then you have an assignment over to you. So this is just high level of some of the things that I was talking about. For those of you who are new, if you wanted to know the type of documents that is involved with this asset. So of course you have your power team if you're in an institutional space, if you're buying notes from a hedge fund or from a bank. These are the players that you pretty much will deal with. A loan servicer is the person that makes it hands off for you. They deal with the borrower, handle any customer service issues. The realtors is your boots on the ground. They will be able to give you, details on the property such as rentals, valuation, check and see if the property is, the condition of the property, do a BPO and all that good stuff. An asset manager basically is like a one-stop shop. So if you're investing from your IRA, you really can't work any of your assets or do anything because it's not in compliance. So you would hire someone like a loan servicer or a asset manager to kind of manage the asset for you. You also have private investigators who can get more detailed information. And of course, everyone's favorite on the power team is the attorney. Attorneys will give you any information that you need as far as regulation, license, and things that you need involved in this space with the note, depending on what state you're in. So this is pretty much your power team, and these are the people that you will deal with on a consistent basis if you're, in the note space. So that was just high level of, most things that people who are in this space would need. So let's jump right into it. This strategy is actually used probably by some of you on the call, and a lot of people know about this strategy, but they're not actually using it. We actually raise capital from different types of resources, but this one is by far, my favorite because it gives an individual investor who may not be accredited or who may not have a lot of capital in their IRA to go out and buy a pool of notes or, buy a bunch of firsts or whatever the situation is. So this gives the investor who have 10,000, 15,000, 20,000 or whatever, and just depending on the unpaid principal balance, sometimes even less than that you can make an investment. This opportunity, when you want to recapitalize on your performing note for the person, the note holder, is a good strategy also. And the benefit is you're able to use that performing note as an asset and hypothecate it and basically borrow against a portion of the principal balance. If you, typically this is from someone in your circle. It's a challenge to walk into an institutional bank and say, I have, 4 or 5 of these performing assets, would you give me a loan? They'll probably look at you like you have 3 heads. Typically, this is probably something friends and family who know or have heard about what you've been doing because you've been sharing information with them, the good, bad, and ugly on your investment, your friends and family, and maybe you have something that is performing and you want to leverage it and go buy more assets. This is a great strategy to do that. The original note owner will retain ownership and is required to give up some of the rights of the note. What I like about this strategy versus one that a lot of people are probably using is selling partials. That's another way to, borrow from the note or sell off a series of payments and things of that nature, but you give up pretty much control over the asset. Meaning, well, let me back up. If you do a partial, basically, if the loan goes in default, what you're essentially saying is this loan has, 360 months, 30 years worth of payments. I'm going to sell you 15 years of these payments. The servicer will get a direction letter to start making payments to the investor who you sold the partial to. If that borrower defaults, then the investor don't get paid. They have options. They can go in and, try to foreclose and create a remedy. But what I like about the collateral assignment piece is basically if I am a note holder and I'm going out to hypothecate this or borrow against it, what I'm telling the investor is that I'm using this note as collateral, but I'm going to pay you regardless of whether the borrower make the payment or not. It's basically as if you went and bought a rental property and you own it free and clear and it has rental income, and you want to borrow against that property, you're using that property as collateral, but you're responsible to make the payment, whether the tenants make the rental payments to you or not. This is the same situation when you borrow against your note. You are putting this asset in front of the investor and saying, hey, here's something I want to borrow against, but I'm ultimately responsible to make this payment. So it's a little, to me, better for the investor because they're not dependent upon the borrower making the payment. And if the borrower defaults, there's some things that I'll get into the benefits on a couple other slides of what is the benefit for the investor if that happens. So documentation to hypothecate the note. So there's probably people on this call who's using different strategies or different paperwork, but this is some of the basics that you would need to provide to an investor. Of course, you should have the original note and the allonges to show that you are the owner in due course and you have the right to collect off this note, and the assignments to prove, you have the collateral to the underlying asset. There's an instrument called the collateral assignment agreement, which some of you on the call may be used to or utilizing, but you have your attorney make sure that the language in this document is good and it matches what goes with the mortgage and the note. And basically with the collateral assignment is that's the instrument you're using to hypothecate it. So you're going to give the investor the collateral assignment, and the language in there basically just says you're borrowing against the asset, which is the note and mortgage. It referenced the note date, mortgage date, and all that other stuff. It also has the terms in there, the interest that you have agreed to pay the investor, the term. It has the option that you want to give the investor. Usually there's some language that the investor has a 60-day call option, whereas if they have another opportunity that they want to invest into and get their money back, there should be some language in there to give the investor that option. Whether it's 30 days, 60 days, 90 days, whatever it is that you negotiate with that investor, that language should be in there. Also, there should be language in there if the borrower defaults, what rights the investor has, whether it's swapping to another loan that's performing to give the investor more comfort, different language that you can have in there. Also, what we supply is a current copy of a credit report to show the borrower's credit worthiness, and also the workout agreement. Again, this is used as collateral, but you're going to pay regardless if the borrower paying or not, but we still want to make a great presentation to the investor if you're a note holder to show that this asset is worthy of borrowing against. So, showing them a current credit report and the workout agreement that you put together. You may want to provide whatever financials that you got from the borrower to show how did you come up with the payment that you put in that workout agreement. You can put different pieces of material in front of the investors to make them feel comfortable. And also information on the subject property to show the equity position. Maybe you might have a BPO, maybe you might have a CMA, or something that shows that there is some type of value in the property. So the investor, depending on which type of investor you're dealing with, will be comfortable with the underlying asset. Again, the instrument, the collateral assignment, should detail options and rights that the investor have just in case the borrower defaults to make them feel comfortable. So the benefits to the note holder, when you buy a performing note, you know that at some future date and time that you can free up your capital by hypothecating the performing asset. If you have an value asset that can be hypothecated and you can take a loan on it, you can arbitrage your cash flow and in most cases enjoy a tax-deferred incentive. So of course, if it's in your IRA and it's a Roth, it's tax-free, or traditional, it's deferred. But if it's not in a qualified account, if you don't have an IRA, there's still a benefit because when you take a loan against it, in some cases, depending on the interest that you've negotiated with the borrower, and I'll show an example in a later slide, there still can be a small arbitrage that you can make as the borrower is making the payments to you and you're paying the investor. You can structure it where you're still making some money. You're not making that entire payment. You're making a portion of it. So, that basically is less interest or whatever you're collecting. So that helps as well as far as the tax basis. So the benefit to the investor is, as I mentioned earlier, a new investor has money to invest and they agree to invest some of it. That collateral assignment is the instrument that will be used. And, it's usually a less risk depending on the loan of value. The investor, maybe you, and I have a slide showing an example with figures. You paid a certain portion for the note and you're going to borrow maybe the same amount or less, which give the investor more protection because if you purchase at a discount and the investor is borrowing at a discount from your purchase price, then that creates more value to the investor. The new investor gets payment from the note holder, as I mentioned before, even if the borrower defaults. The language in that agreement basically will specify that if the borrower doesn't make payments, that me, the note holder, is still responsible to make these payments, and you have an option to swap the loan to something else to make your investment safer or secure, or whatever word you want to use. The new investor, as I mentioned, gets the swap option, and that call option is great also. That makes the investor feel comfortable because they know that they're not locked in. So the terms that I usually see with this strategy is 2 years, 3 years with a 30, 60, 90 call option. 60 days is typically average what's used in this space because it gives the note holder time to swap and to make put a couple of assets in front of the investor. One of the things actually that's not in the slide that I want to mention is if you're presenting information to the investor to make a decision, your third-party servicing report would be great also. So if you have FCI, Madison, or one of those services out there that is collecting for you, you should be able to generate a third-party report to show that the borrower is actually making the payments and that if there are seasoned payments. We typically would do it from 6 payments or more. The borrower is back into the habit of paying, and then we would put that out in front of an investor to kind of make a decision if this is something that they want to loan against. So a third-party servicing record from a third party is a great tool to put in front of them also, or documentation to put in front of them also, because it shows that a third-party company is verifying that this borrower is able to make payments. So here's an example I want to show you of a performing note. And this one is from December 2017, California note. Everyone loves California notes. So this is easy for an investor to make a decision if they want to loan against something like this. And of course, this is a second mortgage. I started off in this space in 2012. With second mortgages, we do seconds and first. We're still doing more of seconds. To me, my opinion is, higher yields, more diversification, and it kind of just works good with first in the hybrid portfolio. But here's an example. This one is worth $318,000. The first mortgage is current. It's a no-brainer. You see that there's equity, and the second mortgage UPB is $51,000, and there's a payoff amount because there's some arrears of $61,500. So basically, we purchased this note for about $21,000, and the annual servicing fees is about $220. So depending on which service you use, some charge $20 a month, $15 a month. It all depends. So that's our cost basically. For the year, of course, that includes a loan boarding fee. So we purchase this loan, we board it with the servicer, and we pay, $15 a month for the servicer. And pretty much, if there's no legal action that takes place over the year, if the borrower falls delinquent, this is typically our annual fee. So, we have about 21.8 invested. And this particular note actually is principal payments, and it's $300 a month for 205 months. So we have some actual restructure where there's no interest. That's crazy to a lot of people on the call. No interest, what are you talking about? But we have some principal payment loans that we do structure to add more value in the workout agreement to the borrower, so they won't feel like they're tied to this forever and they have an incentive to want to pay. So, the return is enough on this. Now we want to create a situation where we're going to hypothecate it. It's a scenario where we season the payments, we show third-party servicing records and all of the paperwork that I mentioned earlier, and we are able to show the borrower that, hey, there's equity here. We want to borrow $20,000 against this note. We want to pay you a 10% return with a 60-day call option. And then we just do a calculation of 10%, and the payment from the borrower is $300 a month. That goes with the situation I was showing you, where you still get the arbitrage, right? So you got back, most of your, if you collected the payments for 6 months, and you got back pretty much after you borrowed $20,000 in the 6 months worth of payments, you pretty much have a small amount invested, and you create a situation where you still can, after paying the investor, arbitrage and make money that way. So, doing this strategy is great. Again, I know there's probably some people on the call who's using this strategy, or some people on the call who know of this strategy but not implementing it. So this is sort of a reminder of, putting it out there. So one may say, where do I find people to lend on this? So there's so many forums out there on Facebook, and there's so many meetup groups now, more than ever, and there's so many events that are happening where you can attend, and you will definitely meet people who is interested in receiving a 10% return, and who may have 10,000 or 15 or 20,000, but don't feel as though that's enough to get into the note business. So this is a great opportunity for those investors who you may meet, to be a part of this process. So the return is infinite. So, if all fails, and let's just say it doesn't go right, here's a few exit strategies for some of you who are new to the note business on this call. So these are the strategies that we have experienced, or the exit strategies that we have experienced in the note business. So the borrower will reinstate the loan if it goes delinquent. You can recreate a different payment plan. Maybe the borrower financial situation has changed and you need to restructure the loan. There has been some situations where we borrow against a note, and then the borrower refinanced and paid off shorter than the 2-year term that we had set. And the borrower is saying, the investor who lent on the note, made a loan on his note, is saying, wow, that was too fast. I was expecting, to make money on my money. Let's switch it to another note. So you'll find that, when you borrow against these things, if the borrow do pay off, you can always move the investor money to another note, or maybe they may want to get cashed out at the time of the refinance. The borrower may get some seller assistance, or you may be able to structure a deed in lieu, or if your strategy is to take the property, which if we foreclose, we fell because we got into the business to receive payments and not properties. So we always try to work it out, but that's another option. You can always sell as an REO. So these are some exit strategies, high level again, for those of you who are new to the space and was wondering, what's the exit strategy if it goes wrong, and how can I get out of it? We have actually experienced, and some of you on the call probably did this as well if you're note investors, where we have what's called a hybrid transaction, where our exit strategy is, foreclosing, and basically we take the property, we own the note, we foreclose on it, and it turns to real estate, and then we take the real estate and put a note on it. What I mean by that is, we purchased a property in Colorado as the first mortgage. We purchased the property. It was vacant. We had to foreclose in order to get the property. Once we foreclosed, we sent the realtor there to do some due diligence, and basically found out that the rehab was not something that we wanted to get involved in. That's not in our wheelhouse. So we went on the meetup groups and marketed, and we found an investor who had boots on the ground who was willing to take on a project. But we didn't want to sell it, and the strategy we created was to create a loan to this LLC, and with a down payment, of course, and finance the deal for the local boots on the ground. And then once we financed the deal, we set up a 3-year term balloon, and once we financed the deal, and got the down payment, we had probably half of our investment in that we had in the note. And then we took that note after 6 payments, and we used this strategy to hypothecate that note. And the money that we borrowed against the performing note versus what we had left, we was able to go out and repeat the process. So this is a powerful strategy of what you can do, whether it's just taking a typical performing note, that's seasoned, and borrowing against it, and or if you have a first mortgage, or a situation where you take control of a property and you find local boots on the ground, and then you finance the deal to them, get a series of payments, and then you want to leverage that instrument that you structure to the new investor, you can hypothecate that and keep it going. So it's definitely a great strategy I could use. For those of you who are new to the space and want to find out more information, we actually have a site where it's free information, where you can go to the site and register, and you get access to, over 150 hours of calls on different types of investment strategies that you can use in this space. There's a lot of known people that have actually had the opportunity to interview and put these calls up. So you can go to NNGNoteAcademy.com and register for free. And if you're new, you can start from the beginning. If you've been in the business for a while and you see a topic that you may be interested in, you can learn there as well. So I'll take some questions. I just wanted to make this short and brief. And for those of you who are utilizing this strategy, if you have any comments or anything that you want to share, and or for those of you who may have known about this strategy and had some performing notes, but I can't figure out how to use it, or I don't know which document you use. Wanted to bring you guys in a call and kind of get some questions from you as well. So we can open it up for questions. Ryan, I always like to leave as much time as possible for questions.
Sure. I did have a few. I should have probably asked you this one earlier when you were talking about it, but I'll start with, can it be a second lien versus a first lien?
Absolutely. So you can do it with both. First mortgages, investors get that all day long. You don't have to educate them about it. It's, hey, I own this note on this property as a first, and I want to borrow against it. That's usually an easier transaction. With seconds, you can do it as well. You know, for investors who may not understand the world of seconds, they may have some trepidations about, you know, making that investment. But if they are educated, I mean, typically to me, my selling point and framework that I use is here is the proof. Here is the third party service and records. Basically, they're lending me the money and I'm using this asset. So if the person has a good relationship with you or know that, that you're a good business person, they're essentially lending you and you're using this instrument as collateral. So, yeah, first or seconds would definitely work.
Awesome. Let me just say this. A few people look like they have to go because they're at work, but yes, email Fu Quan or myself, and we can send you this presentation for anybody that needs that. I'll continue with a few other questions, but just wanted to say that a few people actually asked for it. So email, if you have my contact information, rfisher, Fischer, at CamaPlan.com, and Fu Quan's information is still up. All right, so I'm going to go to a few other questions here.
Yeah, I just popped my email in the chat also. I don't know if you saw it, if it showed up on the screen.
I'll just kind of go a little bit in order here. Can you please define arbitrage?
Oh, so an example, let me just go back on the slide. Oops, sorry about that. So an example that I gave, can you see the slide, Ryan?
Yes, you're good.
All right. So I'm borrowing $20,000 a month on this asset, and the debtor is making a payment of $300 a month. So if I'm borrowing $20,000 and I'm paying an investor $167 a month, I still have $133 a month left over, right? So
right.
1,000 times 10% by 12. All right, perfect. So just making sure my math is right. I'm paying 10% on 20,000, so I'm paying the investor $167 a month, and the borrower is making a payment of $300. There's still a difference of $133 that's left over. That's the arbitrage. So I'm making a spread. I'm using this note to hypothecate it, and then I'm arbitraging $133 a month, in addition to the $20,000 that I borrowed against it. So is this a term that's used when you're creating some leverage and you're still benefiting from it? So that 133 is the arbitrage. To try to explain it by using the illustration. Hopefully I was able to answer your question.
Yeah, I got a few more here for you too.
Sure.
All right. Is there a rule on how much minimum seasoning is needed to hypothecate, or does it depend only on the new buyer?
That's a great question. So again, we typically like to do 6 months or more. We're taking a non-performing note, performing it, and we're creating a track record. And typically what we see is that once the borrower makes 6 consecutive payments, they're back into the habit. Like we're creatures of habit. So the borrower is making their payments every month. It's been about 6 months and they're on track. The frequency, if they're making them the first of every month, fifth of every month, we kind of look at that and see, if the borrower is back on track. Then we'll bring that asset to the street to hypothecate it. So you can do it less. It's a little bit riskier if you just perform a note out the gate and then you're trying to hypothecate it, because there is no evidence that the borrower is going to make consistent payments. There are investors out there who would lend against that. They probably will want, 15, 16% on their money because there's more risk. But the more you season a note, the less, to me in my world, I would pay. The same way I would pay less on something if I'm borrowing against it that has full equity, right? If it's a better deal, I'm going to pay less interest to the investor because they're in a better position. That's just in my world. So, some people have a straight, percentage they pay an investor. So when I meet investors, I'm asking them certain questions. If I'm at an event, hey, what are you investing in? What's your average yield? And I'm writing that on the back of the business card. So if I know this investor is making 8% and I have something at 10% and it's structured properly, more than likely they're going to go for it. If I present all of the right documents. But to answer your question, it's better in my world I have 6 payments because that means the borrower is back on track and they're in the habit of paying.
Okay. And this is another question from someone else, but it's kind of related to that. Do you see this as viable for short-term loans less than a year?
Oh, yeah, you can structure whatever term you want. Typically investors that want to invest in this instrument, especially from their IRA, they want a longer term. They don't want a short term. You do have investors that want a year. Whatever you feel comfortable of structuring it. Also, it has to work for both ends. Like, what are you using the money for? How long do you need it? You may have some information that your borrower is about to refi. That's going to take about 45 days, and you may need capital now. So you may present to an investor, hey, I got to refinance. Here's the pre-approval from the borrower. This thing is going down in 45 days. I need to buy some notes now, so I need to pull out cash, only for 6 months. So you can make the terms whatever you want it. Interest rate, the time, the call option, that's something that you negotiate between you and that investor. But you want to make sure that it works on both parties. You don't want to just, put a loan together that's not going to be beneficial for both parties just to get the money.
Okay. Sorry, there's quite a list here. Could you talk about the pros and cons of hypothecation versus partials? That's a good question.
Yeah, so the pros and cons, as I mentioned earlier, on a partial, you're selling months, and basically the new owner of that block of time that they purchased essentially is reluctant. Their payment is based on the borrower, right? So I sell a partial, I reperform a note, it's a 30, 20-year amortization, whatever it is, and I go, hey, Brian, I'm going to sell you 15 years for X amount, and then you're going to receive, these payments from the borrower. I give my servicer a letter of direction to now pay you. If 4 or 5 months from now the borrower stopped making payments, then my investor does not get paid, right? So the collateral assignment, again, I'm using this instrument and I'm saying that whether the borrower makes the payment or not, I am going to make the payment to you. I'm just using this as an collateral for the loan that you're giving me. So that's pretty much, to me, the difference. Is more, it's better for the investor. It depends on the type of investor you have. You have some investors who want full control. If they're lending you the money, they want to have, the right, they want to have that collateral. They want to have everything. They want to have full control over it. And when you sell a partial, in my opinion, you lose more control versus when you do a collateral assignment. So those are the pros and cons that I feel like you give up more when you do a partial, and then it's the investor risk is the borrower constantly making a payment for those 20 years, those 10 years. Usually partials, 5 years or more, 5 years at the minimum, the partials that I've seen, more than likely they're longer than that, but collateral assignments are shorter. There's a call option in place. It's just more leverage, I think, in my opinion, for the investor who's lending you money on his collateral assignment. They have, more leverage than the partial. They can call their money in 60 days if they need it. They can swap it to another loan without going through a whole bunch of paperwork and everything. So it's easier, it's faster to do, and it's more lucrative for both sides. That's my opinion on that.
Yep. And as we're going through these questions, I do encourage people to reach out and call you or email you so they can get, a longer answer since we're running out of time here today, but I'm going to keep going. Are you concerned about the servicer having issues with the servicing a note in your company's name that you no longer own since you have assigned it to another party?
No, so basically the collateral agreement will spell out, and the servicer will have a direction letter to make the payment too. So, no, I'm not actually concerned about that because we don't have to transfer servicing. We don't have to transfer any of that. The servicer just get a letter of direction now to make the payment. Again, the investor is only getting a partial piece of the payment. They're not getting the entire payment. So I have to notify my servicer and say, hey, every month now, you're going to send this payment to the borrower. In some situations, there are some investors who don't do a directional letter. They just say the payment is going to come to me, and I'm going to, once I receive that payment, make the payment to you directly. So you're really, you're not dealing with the servicer, you're dealing with me. It just depends on what you negotiate with the investor. You can structure it whereas the payment comes to you, and then you push out the payment to the investor.
Okay. Does NNG match borrowers with lenders?
Match borrowers with lenders. I'm confused in that question. As we don't do hard money lending or private lending, so you have to elaborate a little bit more. Borrowers with lenders. Oh, you mean note holders with lenders? I don't know the borrower with lender question. A borrower to me is a debtor. So if you mean, do we match some of the lenders we use with note holders? I'm not sure of that question, Ryan.
Okay. All right. Well, we'll let them reach out to you. Is the investor relying on you to let them know if the loan pays off early?
Yeah. So typically, what would happen is the investor will be. They have to know because they have a lien essentially on this instrument. So when they run title, basically, there has to be some notification for payoff given to that investor to, give their figures to pay off the loan that's owed on the collateral assignment. It is also the note holder responsibility to keep the owner in the loop. If the loan is sold, if the loan is, there's a refinance and it's a payoff request, but the collateral assignment instrument is the collateral that the investor has, and if there is a refinance, the title will trigger that cloud and reach out via mail or the note holder will have to notify to get that information to pay it off.
Okay, hold on a second here.
And while you're going through that, I'm not sure if you guys saw my email. It's fbilal, BILAL, at nngcapitalfund.com. That's FBILAL at nngcapitalfund.com.
Okay. We got time for another one here. If a hypothecated note goes delinquent, does the new lender still get his payment?
Well, that's one of the things that I like about the collateral assignment, because I'm telling the lender that whether the borrower makes the payment or not, I am going to pay the loan. I'm just using it as an instrument to borrow money from you. So
right, you did say that before. Okay.
Yeah, that's what I like that. I like that because, again, that goes back to the other question with the servicing. If the servicer is making a payment to me, the note holder, and then my agreement where I have to pay a percentage for the money I borrowed because I have a collateral assignment agreement with the investor, I'm sending that payment to the investor. So if it defaults or not, it's my job to make the payment. And I have to notify the investor because there's going to be a list pendant, there's going to be some type of foreclosure action that's public record. So I definitely want to be transparent with that investor and keep them abreast of what's going on with this asset. And if I need to swap it, it's not that difficult. If they're receiving payments and they're happy, and you say, hey, listen, we got a situation, the borrower has, defaulted. Usually the language that we'll put if the borrower defaults and it's not, remedy within 90 days, because we can't start foreclosure on a performing note unless it's 120 days late or more. Services typically won't allow you to do that. Usually once it falls 90 days behind, we'll reach out and say, hey, listen, we need to swap this. We got to go down a foreclosure route, and we need to swap this and release the collateral assignment from this asset so we can move forward and do what we need to do. And typically they'll do it because they want to keep receiving that yield. And if the next asset, works out, then they'll definitely green light it and you can move forward.
Okay, great. I'm just going to confirm that FBILAL@NNGCapitalFund.com is correct, right?
You got it.
All right, so I'm going to ask one more question. I do see those, Dennis and Randy. Those are more unique situations personal to yourselves. I would say reach out to Fuquan with those, shoot them an email to help you with that, just because they're unique to both of you guys. But I'll ask you one more question here before we run out of time today. How does NNG make money in this process?
In this process, so we actually, we're not selling anything. We actually borrow against our notes. So the purpose of this call was to share the strategies that we are using to help us create higher yields and create arbitrage situations. Share that information with new note buyers or people who's been in the space and not utilizing this instrument. So we make money by selling loans, pretty much properties, whatever we have in our portfolio for sale. But we utilize this strategy to raise capital on our notes and create arbitrage situations and increase our yield. So the main purpose of this was, education and teaching you guys strategies that you may not be using.
Great. Well, I appreciate you being here with us today, Fuquan, and I encourage everybody to email them with your situations. You can also reach them at 973-855-4922. You can also reach me at 215-283-2868, or you can also get me on an email at info@CamaPlan.com. Appreciate it, Fuquan. Thanks for being with us today.
No problem. Appreciate it. Anytime. And I look forward to you guys' emails. And by the way, guys, I love questions. So feel free to email me. Thanks, Ryan.
All right. You're welcome. Take care. Bye-bye.
All right, guys. Have a great day.